But hopefully what we show you from here on in will be a much simpler way to show you how to make money. So number one is how to construct a synthetic covered call trade. And for that, we're going to go right back to where we just were, into our trading platform. So now we, let's see, I'm trying to think of the best way to start this for you guys. Does anyone have a, let's do it this way. I'll take whichever one comes first. A good stock that you would like to trade. And make it a you know, a well-known good stock, not some small unheard of thing. Tesla. Robert says Tesla. Okay, well, that'll work. I know, good old Elon boy. He's knocking them out of the park. So looking at this, okay, we'll see what we can do here. I like this because it wasn't planned. I don't have this like in the can ready to do. So Tesla, $498.80 a share. So basically $500 a share. So if you wanted to do this, how many shares could you, the average person, purchase at $500 a share in your account? My guess is not too many if you're like most people. So as opposed to outright buying this stock and hoping, crossing your fingers and hoping it goes up, which in this case wouldn't be that much of a hope. Seems like all it does is go up. But since Robert picked Tesla, that's the one we're going to go with. So let's go see how we can trade this synthetically as opposed to outright just buying it. We're going to go to our option chain, and let's close them all down now. So here we have all of our options, all of our various weeks, expirations that we can choose from. So when I do this, what we're looking to do here is find a cheaper way to control a $500 stock. So I like to go out, I don't know, 2 months, 3 months. So I'm going to look here for the sake of this example, 69 days out. We see that in parentheses. I'll go out to March 20. Now the first thing, that's where I'm going to buy my leap. The point is here, we're going to buy an option as opposed to buying the stock. And let me show you how this works. Instead of paying $500 a share for, actually right now it says $478.85, $478.15 is where it closed. So instead of paying $478.15 a share, why don't we, let's look here. What we're going to look for here is to find a call option, which these are the calls on the left side, a call option where the ask price and the strike price equal as close to $478.15 as we can get. So, and let me also say that this doesn't work with every stock. And Tesla may be one it doesn't work with because it's on such a tear right now. So I'm looking like at 460 plus 50, so that'll be over $513. So given the fact here that this is that these options are adding up to be somewhere above 500, which is quite a bit, and a number I want to get as close as possible. So let's see here how much leeway we have. So these are going to be the close-in 6 days out options. And 515, I can still go to 520 and still get decent premium. I'm just looking, I'll explain this in a minute. 25. Okay, so let's go down and see what's the best that we can do here on this. So if we purchase 70, it'd be 1860, that would be 513. So let's say we bought the 460 strike price option. Instead of buying the stock, we buy this option, the 460 strike price, which means we have, for the next 69 days, we have the right, if we own this option, to buy Tesla at $460 a share. So basically we control it at a price of $460. But it costs us $53.40 to buy that. So you have to add that cost into it. So in essence, if you ended up exercising your option and purchasing Tesla, you would not only pay the $460, but you would already have paid the $53.40. So that's why we have a total price of $513.40. So remember that, $513.40. Now then, so you would buy that. So let's do some comparison here. Each option, hopefully you guys know, if not, every option represents 100 shares of the stock. So in this case, it would be $53.40. So you would 53.40 times 100 shares. That means it would cost you $5,340 to control 100 shares versus versus the 478.15 times 100 shares to make it equivalent. Otherwise, it will cost you $47,815 to control the same 100 shares, except you would actually own them. So instead of spending the $47,815 to control 100 shares, you're spending $5,340 to control 100 shares for the next 69 days. So now we go up. Remember I said weekly cash flow. So now we go up to our next expiring week. So this is going to expire January 17th, which is next Friday. So you could have done this yesterday. So it's 6 days out to expiration. Remember our cost basis was $513.40. So now we have to sell. We want to sell. We don't have to. We want to sell an option. Selling now. We bought this one. We bought the down here, the 460. We bought that one. We own that. Now we want to look and see. So we now have 515 that we can sell, which is above our cost basis of 513.40. So we can sell a 6 day out option, a 1 week out option of the strike price of 515. And now because we're selling it, we collect money. So now we're going to collect $3 for each of those options that we sell. So now that $3 is times 100. So that's $300. So that's $300 that we're going to take into our account. Now, let's do the math on that. So we already spent the $5,340 to buy our farther out option. We're now selling the close in 1 week out option. We're collecting $300. So if we collected $300 divided by what we spent to do that, that would give us a return for that week of 0.05% or 5%. So that's a 5% return on our money that we spent for 6 days. So that's not bad. So what you want to do then is you want to sell, again, you want to sell that 515 for $3 and see what happens. Now, 6 days from now, on January 17th, if Tesla is above $515, then you will own the stock. So the stock, someone's going to exercise this call at that point, and they are going to short the stock away from you at $515. Then you will have to go and exercise your further out, your leap. By the way, options when they get further out in time are called leaps. You'll have to exercise the option that you own, bring the stock in at the cost basis of $513.40 a share. But keep in mind, you've already collected $3 a share for this week to put this trade on a premium. Now, if you have it shorted away from you at $515, which means $515 per share comes into your account, now you're short. You have to cover that short. In other words, you have to replace that stock, so you have to go out and buy the stock. But because we have our other position out here that allows us to buy it at the 460 plus the 53.40 or the total of 513.40. So now on top of that, you have, so at 515 minus 513.40, now you have another $1.60 in profit. So now you have $1.60 per share plus $3, yeah, now you have $4.60 profit per share times 100. So now you've made a profit of $460. And then if you divide that by the 53.40, you now have a return of a little over 8.5% for 1 week if Tesla continues to go up. So do you understand that? So you buy the 460, you pay 53.40. Those two numbers together give you a cost basis of 513.40. You can then control Tesla at a total price of 513.40 for the next 69 days. So then each week you will sell a covered call at a price higher than 513.40. In this case, we did 515. Collect premium. If the stock trades above 515 on the next Friday, January 17th, then the whole trade will get unwound and you'll have the same return that I just showed you, total of $460 per share based on the profit we have built in. But what if it doesn't hit 515? Because that's a ways to go yet. Of course, Tesla could do it, but if it doesn't, then this expires, you keep $3, and the next week you sell another call against it, generating another income, and that's the weekly income part of it. So each week you can sell a covered call against your further out option that you own. You can generate a weekly income, collecting the premium from selling that. If the price of Tesla does not reach your strike price of the further out option, then nothing happens. The one you sold expires, and you keep the money and you do it again week after week after week. Now also keep in mind, I know this is a lot of numbers, but let's say your cost basis, and not let's say it is, originally when you sell this 460, your cost basis is 513.40. First week you sell your call at 515 and you collect $3. So now you collected that $3. So now your new cost basis, and you got to keep track of this because it's going to be important later. It's not 513.40 anymore. Now it's 510.40 because you collected $3. So now you've lowered your cost basis to 510.40. Now let's say next week you sell it and collect another $3. Now your cost basis is going to be 507.40, and so on and so forth. So each week that you collect a premium, you're lowering your cost basis or increasing your profit margin should you have to unwind, and should Tesla keep rising up and hit that magic number of 515 and you have to unwind the trade. So week after week, you have the potential to collect a weekly income, weekly cash flow, assuming the stock does not hit your strike price. And each week you're lowering your cost basis because you're constantly bringing in more premium. And if the stock does go up and hit it, your 515, you're fine because you have not only built-in, you have premium that you've collected along the way, but you also have a built-in profit cushion. The difference between the 515 in this case and your original cost basis of 513.40, or the further you go, the more weeks you get into this, the difference between 515 and whatever your new cost basis is going to increase. So the only downfall of this is, what if the stock takes a dive and goes down? So only thing I can tell you there is that in doing this, doing this trade is in lieu of actually buying the stock and holding the stock, hoping that it goes up, or buying the stock and selling cover calls against the stock. Either way. But remember I said, if you actually bought the stock, you would be into it, or whatever it was, $40-some thousand or whatever it was. So that if you this way, you're only into it $5,000. But the risk of the stock moving down in this scenario is the same exact risk you have of it moving down if you outright purchase the stock. So there's no way around that. So in the case of the actual outright buying of the stock, you do have further fall because you paid the entire $47,000, assuming you might have stop losses in there and you wouldn't go that far anyway. But you have the same exact risk. So the downside risk is the same. The difference is this way you're getting into it for far less money. So even if you went into a coma in a hospital and couldn't get to your trading terminal, the max you can lose is the $5,340 max, because that's all you have in it, versus the far larger amount if you actually purchase the stock. And you're still able to generate a weekly income on it, a weekly cash flow, and you're constantly lowering your cost basis week after week after week. So to me, this is far better, far easier than buying the stock. Now, another point is that you could, in worst case scenarios, if the stock were to move back down a bit, in other words, take a break, and with this case with Tesla, the way it's risen, it's highly possible. So as you lower your cost basis, so let's just say we collected that $3 this week, so that put us a cost basis of $510.40. Then we can actually move down and sell a $512.50 call the next week, because our cost basis is less, and still collect a nice premium. And then whatever that premium was, we subtract that from the total. It might allow us to move down one more strike. So if the stock does start to back off a bit, you still have some avenues, and this is what we talked about earlier about adjusting. This is a way of adjusting the trade each week to compensate for the lower price of Tesla. Personally, I would not. I don't like Tesla. I like the cars. I don't like the stock, only because it's too. I think of Tesla as the same as I think of the overall market with Trump. So anytime Trump tweets something, one way or the other, he has the potential of moving the stock markets quite a bit. In Tesla's case, Elon Musk has also a history of using Twitter, and he can tweet something at any given day and drastically cause the stock to go one way or the other. And I don't like. That scares me. So I personally would not trade Tesla. I would look for other companies that are much more stable. For instance, let's look at another big high flyer, which chart looks very similar, if you notice. But the thing is that Tim Cook doesn't seem to have the same problem with his Twitter finger as other people do. So let's say you wanted to do Apple at 312. And I'll go through this one quicker. So Apple is going to lapse all of our weeks here. So I'd probably do the same. I'd probably look at buying the March out here and selling the January. So let's look and see how close we can get to 310. So here we have 320. Looks like it's still going to be up there. So let's see what we have, what options we have on our options. 320, 322. If I could get below 320, that would be much more desirable. So if I did the 290, that would put me in there at 317.40. So I like that. So let me write that down, 317.40. So if we sold that, our cost basis would be 317.40, and then I could sell a 320 and collect $1.27. So if we did the math on that, so then our numbers would be at 317.40 and times 100 means we'd spend 31,000. No, so it'd be 27.40 would be what it would cost us to do it. So 27.40 times 100. So it would cost us $2,740 to get in it, to purchase our leap. And then we would turn around and we would sell the 320 and collect $1.27. So that would be the $1.27 times 100. That means we would collect $127. And then if we divided that by the 27.40, that would give us a 4.5% return the first week on our trade. Now keep in mind, this is 4.5%. The other one was 5%. And if we take in everything, other stuff that we get out of this trade, that's per week, guys. It's not per month, not per year. That's per week. So then we have here 320. Remember, we're at 317. So we actually could have done, if we wanted, we could have done the 317.50. That would have had a 10-cent built-in profit. The difference in 317.50 and 317.40, which is our cost basis. I chose the 320 that would give us a built-in profit if Apple moved up further and hit 320 and we had to unwind the trade. That would give us, what, $2.60 extra profit. So that would be an extra $2.60 on top of the $1.27. So just to give you an idea, 260 plus 1.27, 387 times 100. That's 387, and if we divide that by the 2740, that gives us a 14% return if Apple moved up and we unwound the trade. And if it didn't unwind the trade, we had a little over 4.5%. So you see how these trades work? It's like it's good or it's really good. So, and again, the only downside we have is if the stock moves down. But at the same time, by working on Tesla, I don't know that I feel the same way about what I'm going to say here. But on Apple, how bad can Apple get? I mean, Apple is Apple's Apple. I mean, you know, if your biggest fear is Apple tanks and you're stuck, you know, owning the stock at a higher price or the option, looking at this chart, this is much better. This is a good, steady, solid ascension. Versus, look at this. I look at the volatility in this stock. That's not something I want to be in the trade in, the stock that moves with this amount of volatility. And then let's see, Casey says, bid is selling, ask is buying. Yes, correct. And then Jack says, do I look at open interest in choosing an option strike price? No, I do not. Couldn't care less. Chances are when you do this in your account, you're probably going to buy, I'm guessing, I don't know for sure, but single-digit options, 1 option, 2 options, 3 options, 5 options, not many. So you don't need a lot of open interest or volume. And other than nothing else really matters. All that matters when you're doing these, the only thing that matters is that you construct the trade correctly. So again, the construction part of it is you want to go on the further out ones. You want to find a combination that is as close to the actual current price of the stock as possible. But what I tend to do first, I take a shortcut. I look at the week that I'm going to be selling them in, the close-in week, and I see, okay, where am I actually going to be able to sell these and still make enough premium to make it worth it? So that's why I kind of zeroed in on the 320, because that was $1.27. After that, it started dropping down below $1 and so on. So I really didn't want to go down that low in price. It wouldn't be worth it to me. So I said, okay, I can go with $1.27. So then I said, okay, that's my 320 price. Then I went up and I looked to see if I could pull that off, if I could find a combination in here that ended up putting me below 320. And of course, the cheapest one I could find, or I guess they all would have done that, but I just happened to pick the 290, which would make it 217.40. So what you want to do is make sure you construct the trade so that your ask price and your strike price, 1, get as close to the actual trading price as possible, but 2, and more importantly, is below what you've already figured is your worst case, one that you can sell up here. So in this case, I knew I didn't want to go anything below 320 as far as what I was going to sell. So that was my limit, was 320. So I had to find a combination that was less than 320. So then you just come back here and start doing the math and start adding them up and see what you can find. And one other tip is that you have many choices here, and the further in the money you go, the more the option is going to cost, but the better combination you're going to get. But so like here, 240, this would be a 211.75 would be your cost basis. So if your cost basis was 211.75, then you could go down here and almost sell out the money and collect 345. But I don't want to do that. I'm doing this for the reason of I want to spend as least amount of cash as possible, still collect a weekly cash flow, and set it up so that if the stock does rise up to my strike price, that I can get out and have an additional built-in profit just in the construction of the trade. So hopefully this makes sense. You can come back and look at it again in the recorded version that you're going to get. And you can also ask more questions later on. But just play around with the numbers. But if any of this concept you don't get, ask me later, and we can go over it all you want. And also, well, I'll talk about the other later. So that is it for the covered call. And this, of course, works best in either, obviously, a rising market. I like it best if it's a steady, slow rising market, or even a sideways market. This works very good in. Downward markets, of course, it would work for a little bit, and then you may have to, worst case scenario, if you're dealing with a good company. So again, as I said, if you're dealing with Apple, how bad is Apple going to get, right? So if you did have to sit it out for a while, say if we did have some kind of minor correction in Apple, you know, like maybe this area in here, a minor correction, you might have to wait it out, but you can be sure that Apple is going to recover. So that's your only fear. But anyway, what I'm saying is that I'd still much rather get in for as low a price as I can, control the shares for up, in this case, 69 days. So think of how many weeks we have in 69 days that you could generate an income off of this. Now, one other thing I want to point out too is that as we start getting close to expiration, so we start out at 69 days, but once we start getting into where there's like a month left before expiration, we're into March at that point, let's say March 1st, and it's going to expire on the 20th. You have two choices. First off, let me say one thing. First off, I am almost never still in the trade when it gets to that point, because usually the stock has moved up and I've ended up closing the trade and gotten out of it with max profit. But let's just say the stock moves sideways and keeps going that way and doesn't really hit your strike price, but each week you still get to collect that premium. You're still lowering your cost basis, and you get to the point to where you're into March and you still own this leap out here, the 290. What you would want to do is roll that out another couple months. So rolling means that you take the position and you roll it out. So you would buy back this one and you'd sell another one another 60 days out, let's say. And then you would keep going. So if you get to that point and you still have the leap and everything's still working fine and the stock is kind of trending sideways, just roll this position out, buy yourself another 2 months of time, and continue as you've been doing. Weekly cash flow. So that is it for this particular strategy. Hopefully hopefully I explained it well enough for you. And if not, like I say, we're going to have unlimited Q&A at the end. So now, how to construct a synthetic covered put trade. So we're going to go right back to where we just left, our trading platform. So let's do this on Apple. While we're here, stick with the same one. So now, this one is, at least for me, it's tougher for me to explain this because I have to think more about this one. Because typically I tend to think in terms of things moving up because, well, I'll explain to you why I think that way. This is going back 20 years on the S&P. So if you were to look at this chart, what would you say that the overall trend of the markets in general is? And of course, you're going to say it's up because it's from the lower left to the upper right. So even though we have corrections along the way, some bigger than others, nonetheless, markets move up. So consequently, share prices move up. So because of that, I tend to think in terms of positive movement. I tend to think in terms of going up. So that's why I have to think more about these trades when we talk about the synthetic put trade. But it's still a good trade. So now we have to think about what we're doing here. So let's, again, same deal. We're going to buy something further out and we're going to sell something close in. So let's stick with March. So now let's look once again at something trying to get as close to our strike price as possible. I mean, our actual trading price as possible. So let's see. So we could do, now we're on the put side, not the call side. So 290. So first off, let's go back and look at the week coming up, what we would sell. So we would want to sell a put, which if you sell a put, that means you're agreeing to take the stock in. So that means somebody could put it to you at that specific price. So let's say, so let's look at 305. Let's just say for the sake of this argument, 305 is what our price would be. So that would be 307.29. No, 307.33. 307.33. Let me write that down too. So that means somebody could put the stock to us and at 305. And actually, we're subtracting here too. Actually, I did the wrong way. So that would actually be, they put it to us, but our actual input price would be 302 something. I should do the math. 5 minus, because we're collecting that premium, 2.33. So that means they would put it to us at 302 would be actually what it would be put to us at. So now what we want to do is make sure, if that happens, that we can put it to somebody else at a higher price. So now we want to make sure that we sell something above 302. So we could buy the 305, and we'd have to pay their 305. And since we're paying that, we have to also subtract that from it. So let's 300, 302, 303. Okay, so that would work. So let's just give you an example of how that would work. So you would want to buy the 330 put, pay $26.90 to buy it. That means if somebody put the stock to us, so if the price moved down enough and it moved down below 305, then somebody could force us to take the stock at 305. But we've already collected 233 to take that obligation on. So really what we're looking at is 302.67 would be what would be out. So if the worst case happened and it got put to us at 305 minus the 233, that means we're negative now on the deal, 302.61, or 61, I think, or 61. So now then, if we had over here, if we bought the 330 and subtracted what we had to pay for it, that means we could now, since we own that put, we have the right to take that same stock that was just put to us at 305, put it to somebody else at 330. So in and right back out again. But since we paid the $26.90 for it, then that means we were at 303.10. So 303.10 means we have a, what, a 303, so 302. So we have 30, so we have about 50 cents. We have about 50-cent profit in there. So it's not a lot, but nonetheless it's a profit. So we could put that out to somebody at a 50-cent profit if it all happened. But let's look at what our percentages would have been to begin with. So we would have collected, let's do the math, I'm sorry, do the math down here first. So 330 would have paid $26.90, so $2,690, so $2,690 is what we would have paid to buy our 330 put. We would have collected 233, so $233 times 100. I mean, if we times it by 100. So then we would have 233 divided by 2690. So that's a little over 8.5%. So there we have 8.5% return for the first week. We have another 50 cents. So if we added that in, it's not going to make a big deal, but it's still going to make a slight bit. So again, that was what, 233 plus 50, 292. That brings up to 10.5%. So we hit a 10%. So if we put this trade on and the stock did fall down below 305, then we would have a 10.5% return for the first week. If it didn't fall below 305, then we once again could sell another put. And your biggest fear here is that the stock moves up in price. So see, that's the part that I don't feel totally comfortable about, that to me, as I showed you with the S&P and the chart, the fact that overall, given the history of the stock market from the beginning to now, it moves up. Everything moves up. It might take time, it might have corrections along the way, but it moves up. So you can assume that worst case scenario is if you wait, the stock will move up. Looking at that same chart that I looked at on the S&P, probably not there, it is there. If you had to wait for corrections, you may be waiting a while. So I tend to keep my mindset focused on trades that benefit from rising prices, not from falling prices. But if you find a stock that works well moving sideways, this would work. But what I like to say about this trade the most is that, let's say, which I don't think we will, but you never know, let's say we hit another year like 2008 to where something happened, and I guess it could happen. Who knows what would be the catalyst, but it could. If the market started tanking and kept tanking for an extended period of time, then this trade would be a moneymaker for two reasons. One, it's going to benefit from stocks falling, which is what this would do. But number two, and even more importantly, and this is getting into options and option pricing, one of the major components that determines the option price is volatility. So the higher the volatility gets, which is also known as the VIX, the higher the volatility goes, the more premium is built in to all options. So in 2008, like right now, if we look at the VIX, you'll see that we are living somewhere in 11, 12, 15-ish places, as far as what the number of the VIX is. Back in 2008 at one point it got up to almost 90, which is so far above the norm. So my point being there is that in times of market distress, in times of panic, when the stock market world looks like it's coming to an end, the volatility increases, the VIX goes up. When the VIX goes up, the premium goes up. So in periods of like 2008, which I could say, I don't know if we're going to get one of those, but we could get mini versions, shorter versions. The VIX goes up, premiums go up. So when you put these same trades on that we're seeing, 8, 9, 10% on now, I mean, that percentage could drastically increase just due to the nature of the fact that panic is in the streets and the volatility is increasing radically and premiums are going with it. So it's a good trade to have in your toolbox. It's a good trade to use. Now, of course, there are a lot of people out there that make their livings shorting stocks. That's all they do is find stocks that they think are overvalued and they short them. This trade would work well for that too. But other than that, I think that covers how that one goes. So next up in line, and we're running out of time here. Next up in line is how to trade futures in a small account. So the standard method of trading commodities is practiced by most futures traders is either buying or selling, which means going short, a futures contract. For those of you that with smaller accounts, the problem with this method is that it carries the greatest level of risk. This is because of two factors. First being the associated large capital outlay required to cover the margin required to either buy or sell a futures contract, which is a small account would be impossible. Then the second is the fact that the high level of leverage involved with all futures contract. And once again, within small account, this would be far too much risk. This means that any small move in the price of the futures contract will result in a relatively large move in your account. And if the price moves against you, that amount could be staggering. So now let's look at several ways that you can lower the level of risk capital required and still being able to trade commodities. By the way, this is one of my favorite trades to make of anything I do. I do more of this than anything. The first way to lower your risk would be to trade mini contracts instead of trading the full-size contracts. These are typically a tenth the size of the full-size contract. This would considerably reduce your exposure to risk and still allow you to trade the commodity directly. But the problem with this is that only a few commodities have mini contracts. So this is going to limit what you can actually trade. But another way you could trade commodities and lower your risk and the required capital would be through the use of our old friend, the option. And the good news is that you'll have several option strategies available for your options. Now this will require you to do a limited amount of technical analysis in order to construct your trades. And like some of the other topics we've already covered, it will require you to have some knowledge of option trading. So hopefully you have that. For this masterclass, I'll assume that you understand option basics, because if not, then it would end up being a totally different course because we'd have to go in a different direction. And I'll also make the assumption that you are skilled in technical analysis, because if not, this would also still be yet another different course. But I have quite a bit of technical analysis already. We've covered it already today, so you should be good. So the following is a list of data that you will need to collect via the charts through the use of technical analysis. You'll need to determine the overall trend of the commodity. Is it going up? Is it going down? Or is it trending sideways? You will need to identify areas of support and resistance. Or another way of looking at it, you will need to identify a range that the commodity is or has been trading in. And then 3, you will need to go into the options table for your chosen commodity and identify an option that would be expiring in about 30 days. So these are not weekly trades. These are monthly trades, roughly a month. Now, in the last item, there's one thing you need to keep in mind, is that based on what brokerage you use and what trading platform you're using, every commodity may not have options that you can trade. So this will be one negative you'll have to deal with. So it may be a good exercise to go through the commodities on your trading platform and note which commodities have tradable options and which do not. Then you'll need to stick with that list when doing your analysis. Once you've chosen the commodity you want to trade from the list of commodities that have tradable options, then you will want to perform the required technical analysis that I listed prior. So now you're ready to construct your options trade. So as you know, my favorite option strategy is selling options. And as you guessed it, this will be no different. I'm going to show you how you can still sell options against your chosen commodity and drastically lower your risk while still getting nice double-digit returns. So if you're ready, let's look at several different ways you can achieve this with your option commodities. So first, let's break it down in 3 possible scenarios. And of course, this will be determined by your technical analysis. Number 1, let's say the commodity is an uptrend. You could do 2 things. You could sell a naked put, like we just saw, or you could sell a vertical put spread. And I'm going to get into more of that in a minute. Number 2, if the commodity is in a sideways pattern, you could sell a strangle, or you could sell an iron condor, and I'll define those in a minute also. Number 3, if the commodity is in a downtrend, you could sell a naked call, or you could sell a vertical call spread. So these are the 3 things, and we're going to describe them in greater detail, don't worry. So now let's look at the pros and cons of those different trades. So to make this simple, let's combine trade A from each scenario, since they were all basically the same category. Each of those trades consists of selling a naked option. By doing this, you will have the following. You'll have less capital required versus buying or selling the outright commodity, but far more capital required than any of the trade Bs from each scenario. And you're also going to have a greater percentage return than any of the trade B scenarios, but at the same time, with greater return, you're going to have greater risk. And here's the problem with these trades. Since you are selling naked options, then your risk is somewhat unlimited, which is something you wanted to get rid of based on your original question and desire to lower your risk. Therefore, the return was greater than the B trades, because the greater the risk, the greater the reward. So your first goal should be to reduce risk whenever possible. So let's agree that we'll eliminate all the A trades and stick with just the B trades. So these trades, since they are not naked, provide you with predefined and limited risk, as opposed to unlimited. You know up front what your max loss could be. You also decrease your required capital to such a small amount that I think you're going to find it hard to believe. So these trades will provide great double-digit returns in the 20 to 30% range based on the capital required month after month. Sounds pretty good, huh? So as you can guess, this brings us to the point where we need to go back into a trading platform and show you how to exactly construct these trades. So let's look at some futures contracts. So let's go to the chart first, and let's look at natural gas, /NG. So as you can see, I have some lines here I've drawn prior for my own trades, and you can see the natural gas trades in a range. It comes down near this level of support, typically goes back up somewhere near the top of the range, comes back down, goes back up, hits the top of the range again, works its way down slowly. So in other words, it's range bound. It's trading in a range. Now, one of the things that I like about natural gas so much is that we have it coming out of our ears. Because natural gas is a byproduct of all the fracking and shale operations going on in our country, we are just like we have more natural gas than we know what to do with. So it's not a supply and demand issue really, because we just don't know what to do with it. We have so much, which is why it's gotten as cheap as it was prior. It used to be, go back a few years, it used to be a lot more expensive. Now it's not, because it's just, we have so much of it. So let's go look at what it would take to trade natural gas. And let's look at it first from the standard way of trading it. So now let's look at the active month, 18 days out. Let's go to, well, it's really irrelevant anyway. So let's say you wanted to buy a natural gas contract. So because it's near the bottom of the range, it might be safe to say that it's probably going to turn around and head back up. Let's just use that as a philosophy. If you wanted to buy it, you would right click, you'd say you want to buy a single contract. So if you wanted to buy one contract, hit confirm and send and preview it, you would have to put up $3,000 to purchase one contract. $3,000 per contract. So remember I said this is showing you how to do it in small accounts. So many of you might not have $3,000. Maybe you have a small account that only has 1,000 in it, let's say. Which remember I also said that was about the minimum. And now some futures contracts can be way more than 3,000. But this is $3,000 in order to buy one contract, which is a directional trade, which means for you to profit, it has to move up. If it moves down, it can move against you, and it could eat up that $3,000 rapidly, which means you would be out of the money. You would be out of money if that's all you had in your account. So let's forget this. We're not going to buy the contract. Instead, let's look out and see what we got. We don't have anything 30 days out, but we do have a 45-day out. So let's look at that one, 45 days. So now what we want to do is, remember I said, yeah, you could either sell naked options or you could sell verticals. We're going to sell verticals. What we're going to do on this is we're going to sell an iron condor, which an iron condor is comprised of a call vertical and a put vertical. And if you don't understand it, just follow along with me. Hopefully it makes sense. We want to sell those at, we have delta. That's a Greek, and that is something that we use to figure out where we want to be. So in this case, we want to be at 10 or below, a delta of 10 or below. We have 11, we have 8. We don't have a 10, so we're going to go below. We're going to go with 8 delta. So the way we use this is you subtract the delta number from 100. So in this case, 8 subtracted from 100 is 92. What that says to you is this particular option has a 92% chance of expiring worthless between now and when it gets to its expiration date, which is 45 days out. That's good. That tells us we have, remember, if we sell the option, we want it to expire worthless. That's what we're after. That's our goal. So in this case, by selling an 8 delta option, we have a 92% chance of being successful. So that's a pretty good success odds right out of the chute. So we would sell an iron condor. So what you want to do is click on that line. You want to sell iron condor. Now that populates it for us. It knows that we wanted the $1.80 put, but it doesn't know necessarily what we want for the calls. It just puts a number in there to fill the space. So now we want to look over at the call side, find a 10 delta call, and we have 2, so I'm going to go with the lower one. So then we want that to be 2.7. So our short leg there is going to be 2.7. And the next one above, 2.71. Now, let me explain one thing quickly. A vertical means that you are short a call, and you're short, a vertical is you're short one option and you're long another option. So if you were going to sell a naked call, you would be short a 2.7 call. But that would be where you would have unlimited risk. So if you're short the 2.7 and you're long the 2.71, that caps your loss 2.01. So that means that whatever unlimited risk you had here, it can only go as far as 0.01 more. So it drastically limits your risk. Remember before, to put the trade on, well, let's look at something different for a second. I'd rather do this differently. Excuse me for this, but I just got this idea. So 2.7 was, let's just say we want to sell a single. Make that a 1. We would collect 14 cents, or 1.5 cents actually, times the amount of barrels or cubic feet there are in the natural gas. That means we would have to get a credit of $136, and we would tie up $1,055. Our max loss, you see this word here, is infinite. It means it could go even further. So we have an unlimited risk. We're collecting $136, and we're having to put up $1,055 just to put the trade on, but that doesn't mean it's capped at that. It could go beyond that to infinity. So that's by doing it with just a naked call. Now let's say we sell a vertical, 2.7, 2.71. Now we're collecting much less, but look at this. Now we're going to get a credit of $2.46. Our max loss is $90, and we've only got to put up $45 to put this trade on. So if we looked at it purely on the call side, if we look at it purely from the call side, 2.46 divided by 45 that we got to put up, that equals 5.5% for this trade. But it's going to get better. But that's what it would be for this trade right here. So that's we've limited our risk. We're still getting our 5% return, but let's do a little better than that. So now let's put on the iron condor, which means we're selling a call vertical and a put vertical. So now we want that to be 2.7 and 2.71. And if I remember, our put side was 1.8 on the short leg and 1.75. If we look at one contract there, now we're going to collect $24.92. We're going to have to spend $161, or at least tie up $161 to put that trade on. Worst case, if the market fell out from under us, $460 would be our max loss. But let's see what we're going to get, at least just for the basic trade itself. So again, 24.92 divided by 161. Look at that. Almost 15.5% for that period of a little over a month. So if you were doing other trades, let's say you're doing some of the covered call trades, synthetic covered call trades, and you want to subsidize yourself with some option trades or futures trades because you want to diversify. I always like to tell people that everyone's telling you that you need to be diversified. And when they say that, they tend to mean that you want to have some stocks in industrials, and maybe you want to have some tech, and maybe you want to have some retail, maybe you want to have some banking stocks. That's their definition of diversifying. My definition of diversifying is you want to have some stocks, you want to have some commodities or futures, and you want to have some currency or some forex. That's truly diversifying, because the stock market could fall and it might have zero effect on some of the commodities you're trading. So you need to have a good balance where one is not affected by the other. I mean, nowadays, how many news events do you see come out, like a tweet from Trump or something, where the entire market falls? So if you were diversified across all sectors, they all fall. So I don't know what good being diversified means unless you're diversified in this manner, where you're in different groups: equities, currency, and commodities. So anyway, almost 15.5% for this trade, if you put that on. So not bad for a trade. Let's look now. The next, this shows you how you can trade on a very small account. Remember I said you could trade small, $161. Your max loss would be $460. So that's why I said if you had a $1,000 account, you could actually do 2 of these trades if you wanted to, and still be within the realm of safety. I would not do 2. I would do 1, and then I would do something else with the rest of the money. But just to show you that you can actually trade, believe it or not, you can trade commodities even if you don't have enough money to trade stocks by doing it this way. So that's kind of pretty cool, I think. So now let's look at the next thing in line on our slide presentation is how to trade Forex. So we were just looking at how to trade futures, but now how to trade Forex without having a Forex account. And because this is exactly the same as our method of trading futures, I'm going to include this in there. So now let's go in and look at that too. So let's say, for instance, in here you have, in futures, you can trade Australian dollar, British pound, Canadian dollar, euro, Japanese yen, Mexican peso, New Zealand dollar, Swiss franc. So you don't have all the currencies you can trade that you can with Forex on a Forex platform, but you have all the majors. So let's look at, let's say the euro, because I happen to know it's a really good one to trade. Correct. 6E. So if you look at a chart for 6E, as you see, it too trades within a range. Even though it's trending lower, it's still trading within a range. And remember, this takes up quite a bit of time. We only need to predict the next 30 so days. So let's look at this and do the same thing. Let's go out. Here we got 55 days. So let's look at that. Let's do the same iron condor, 10 delta or less. Right click and sell iron condor. Then we got to figure out the put side. 8, 115. 115 and 115.5. Make that one contract. Let's see what it gets us. Now we're getting $47.02, tying up 133. So on that one, 47.02 divided by 133, 35.3% of the money you tied up for the one contract. And I do these every month. Every single month, I do the euro, I do natural gas, I do crude, and I do gold. We can look at gold. Gold, I'm not sure if it's a commodity or if it's a currency anymore, but we can look at it. Look at the chart. And again, we have the range. It stayed in that range. It's behaving very nicely in that range. Of course, it spiked the other day when the market took a dump. That was when the missiles hit Iraq. And since then, it's backed off, and it's more normal now. So let's go out. We've got 20. We've got 45. Let's go 45 again. And do the same deal. They're all the same. Once you learn how to do it on one, you can do it on all of them. 10 delta. Right click. Sell. Iron condor. Come down and see what the puts or the calls are going to be. 10, 10, 1685. And 1690. One contract. Here we're going to bring in $45.12 divided by 159. Divided by 159. That's a 28.3% return. So think about it. Think about it carefully. If you put one of these trades on, or 2 or 3, I personally would not do more contracts of one. I would do one contract of more of different ones. But let's say that that's for every month on this particular chunk of money that you want to allocate to the commodities. If each month you brought in between 10 to 20 some percent every month, not bad. Not bad at all. Now there also are which we can't get into in this class, but we kind of talked about it a bit when we talked about the other ones, the leaps, that if it got down to the to where your option that you owned got close to expiration, you might want to roll that out and buy some more time. There are several good adjustment techniques that you can do with these. If the price of the underlying commodity started to approach either your call vertical or your put vertical, there are adjustments you can do to reshape the trade so that it's once again more centered around the price of the commodity and you are in good, healthy shape again. But again, we would have to have more hours to go into those things. But just to let you know, they do exist and they're not hard to do at all. So that is how you would trade. That's how you trade a Forex in a regular account. You can do it through futures, trade the currency futures, which is the same as trading Forex, and you can profit for very little money and do very, very nice at it. If you do want to dive deeper, we do have a 2-day Forex course that will teach you how to trade it correctly, not that this is incorrectly, but trade it on a Forex platform where you're trading pairs. But to be honest with you, I would actually prefer doing it the way I just showed you to doing it that way any day, which is what I do. So how to trade a market that is overbought or oversold. Now, I know a lot of you out there probably like to do your research and gather information, form your opinions, and to do that, you tend to listen to, hopefully, you're going to stop it now, but you've been listening to the financial channels like CNBC or Bloomberg, and maybe even the old school ways, you like to just read it, look at the Wall Street Journal or other print publications. Then there might be some of you that just like to dig in and research individual companies themselves. No matter how you gather information, there's one thing I can promise you is that there is no one person or software program that knows what the price of any stock, bond, currency, or commodity will be 1 hour from now, 1 day from now, or any time in the future. No one knows their price will be in the future, period. But the problem with it is, I can't talk. The problem is that with the media, it does such a good job of getting their information to the retail investor that most trading decisions are made based on this massive amount of fake news that's created just for the unknowing investor. Then the retail investor takes in and digests this information and then ends up forming opinions, which then turn into beliefs, which ultimately the trader or investor makes a trading decision as actually desired by the media outlet that originated the information. In other words, they've coerced you, convinced you to do what they wanted you to do to begin with. And this goes on day after day, and in most cases, the only one that wins is the brokerage firms, not the retail investor. This brings us to the subject of technical analysis. Let me tell you a secret. Again, repeated, there is nothing out there that you can research, no news that you can dig up, no unreleased products, no one knows about, no one management decisions. There's nothing out there, period, that your hard work can uncover that is not already known. And because of that, all news, all information is already built into the current stock price. This is why you don't need to do all the legwork involved in fundamental analysis. Instead, become skilled in technical analysis, and your job will become much more enjoyable. Plus, when you try to do all the research yourself, you only end up getting bits and pieces of information that you need to perform any kind of correct assessment. Then you have to interpret this information and form an opinion. All of this, of course, is a very subjective process open to all types of misjudgments that can be weighed heavily by your already formed biases and beliefs. So this is why you need to become proficient in the use of technical analysis, and all the work of gathering information is already done for you. And I promise you that nothing is left out. Everything that's out there to be known is already being assessed and is reflected in the current price, which the candles on the chart will show you. So always remember that the current price always reflects all the information that's public. Nothing's being held back. There's nothing that you're going to be able to uncover that is not already there. So I just want to spend a little time setting the stage for this because people always seem unsure on where the market is and what would be the correct time to enter the market at any given time. And of course, the next thing would be when to exit once you get in it. So technical analysis will give you that exact information without you having to do any type of interpretation. So this one I want to cover with you. How to recover and deal with a recent loss. So all of you guys either have, or I promise you, you will have a loss in your trading account. Sometimes bigger, sometimes not so big, but you're going to have them. And chances are some of them might be larger. Hopefully after at least talking through this course today, you're going to realize that stop losses are very important. And if you do it correctly, like I showed you with the parabolic SARs, and put your stops where those dots are, that'll keep you from having any kind of massive loss. But nonetheless, losses are going to be a one thing that you cannot totally avoid. So now I'm sure if you're like me and almost every other trader out there, you've probably experienced a devastating loss at some time in the past. For some of you, that could have been the end of your trading career. For others, it might have only been a temporary setback. But one thing I can be almost 100% sure of is that it affects your trading mindset in several ways, none of which are positive. So for most of you, the first reaction is to start questioning your trading plan. So assuming you in fact do have a trading plan, and if you don't, then that was most likely the cause for your loss to begin with, because without the trading plan, you probably wouldn't have had your stop loss mechanics, you wouldn't have any kind of risk assessment, so make sure you have a trading plan. Let's assume you did have a trading plan, and we'll begin to question it, looking for the cause of the loss. That'll be your first place you're going to look. Now beyond that, let's look at several other reactions that the typical trader will have. Number one, you're going to freeze, become paralyzed, and not be able to place any trade for fear of taking another loss. I've seen some of my students take losses on their accounts, and for the next God knows how many months, seems like, all they do is dwell on that loss. They can't get past it, and they can't get into another trade. They can't do anything. That's all, that they're stuck there. So that will be one thing that will most likely happen. Number two, they will question their stop loss placement and decide for future trades to move it further out, or even worse, not place one at all. Because if they didn't have the stop loss order on that last trade, then they would not have been stopped out and incurred the massive loss. They would still been in the trade, and it could be even worse. But most people think that if they don't close the trade, then there's always that hope that the trade will recover and you can get back to break even. So many times they blame the fact that the stop loss got hit for their loss, and they, in their own mind, tend to think that if I just don't use a stop, I'll be better off. And you won't, because at some point, whatever loss you were trying to avoid could be 10 times bigger a little ways down the road. So when traders incorporate stops, that should prevent any kind of massive loss from occurring. That's why you have them. That's what they're for. And the only way to have a massive loss when you're using stops is if your trade size was way out of proportion for the size of your account. Or you adjusted your stop loss location as a temporary solution to avoid the loss. So sometimes people say, I know I got to have a loss, but maybe if I just move it out a little further and give the market a little more room to breathe, it'll come back and I'll get the break even and get out of this trade. And instead, it ends up hitting a stop loss order that's even further out, which means the loss was even bigger. And that loss ended up becoming the massive loss that should have been taken when it was smaller. And number three, this third reaction is the most likely and the most dangerous. The trader will become angry. They will be angry at the market, and they will begin on a path of what we call revenge trading. This is where the trader will lose all logical sense of proper trading and just be focused on getting back his capital that was just stolen from him by the markets. And the trader will do some or all of the following. Number A, it would be trade too large for their account size in hopes of making back larger portions of the loss all at one time. Or B, they'll overtrade, making too many trades, not using good trading logic, and just blindly placing trades in hopes of making back their loss. In other words, they're just trying to trade anything and everything, trying to get it back. Totally all logic goes out the window. Or three, they're going to remove their stop loss altogether, since they blame that for the losing trade that they just had. Totally toss out their trading plan. That maybe has worked perfectly for them in the past, but at this point, they don't trust it anymore. This means that now the trader is trading without any rules or guidelines. And this is a sure way to another massive loss just waiting to happen. So I'm sure I could think of some more, but I'm sure you get the idea. Instead of talking about what traders should not do, let's instead talk about what they should do. First, I feel most important, they should totally stop trading, believe it or not. Based on the size of the prior loss, this pause in trading could be for a day, could be for a couple of days, maybe even a week. And this will give the trader time to calm down. And if possible, the trader should try not to think about anything trading related. I know it's hard because you just took a loss. But try not to think about it. I know this can be very hard, sometimes impossible, but try. Now, after they have taken a break and decide to return, they should first review their trading plan. Now, don't throw it away, review it. And also review their other past trades, ones that occurred before that last losing trade, and reassure themselves that their trading plan was in fact working. And this is why it's important to not only have a written trading plan, but to also keep a trading log of past trades so that you can go back and assess them later in case you need to go through this exact exercise. And number 3, now it's time to jump back into the water again. By now, the trader should start out trading very small, as opposed to the angry trader or the revenge trader that was trying to trade too big and make it all back at once. Back off, trade very small. As I said before, the natural tendency is to try and make it back as quick as possible. That would mean taking far too much risk. And that added risk will just be fuel for the trader's fear and greed that most likely prevent any logical and clear thinking to take place. So think about it. You've just taken this loss. You had to take a break just to calm down. And I'm sure your emotions are on an uneasy footing, to say the least. So if you start trading big now and you see that the possible risk amount that you're taking is on the large side, all that's going to do is put more fuel to the fire for your fear and greed, which is going to consequently cost you to start to make stupid, dumb decisions in your trading. And it's going to become a self-fulfilling prophecy. You're going to be right back where you started, take another loss, and probably out of the game. So by starting out small, this will do the opposite. It will not put a strain on the trader's already fragile emotions, the fear and greed, but instead allow him or her to slowly build back their confidence. Then over the next weeks to months, slowly increase your trade size until you're back to your pre-loss trade size. So the point of this is to slow down, calm down while you rebuild your trading confidence. Remember, your emotions will be on high alert after suffering that kind of loss, and you'll have to be very careful not to fuel that already burning fire. Instead, you want to remove fuel so that it will just burn itself out. So I like to end this by pointing out something that is obvious to me and that anytime someone suffers a massive loss in their trading account, I can guarantee that the trader was not taking proper risk management controls. If a trader employs correct risk management, then all losses will be contained and they will be small and manageable. This is the reason that 90% plus of all beginning traders end up blowing out their accounts and giving up. It's because they have not learned about proper risk management. Instead, they just place their trades and hoped for the best with no protection on the downside. So I hope you never have to suffer this type of loss, but in the event that you do, then please go back and read over this and then look very carefully at your trade. And I can promise you that somewhere in that trade, there could have been something that you could have done that would have prevented that loss from occurring. I promise you it's there. If traders will spend as much time thinking about how to protect their trading capital while in a trade as they do thinking about how much money they can make, then they will be far more successful and actually end up making more money. Many times, less equals more.